What's up everybody, I am Jaspreet Singh, and you don't have to look very far to see that people are worried about a potential recession. They're worried about the markets, they're worried about inflation, and they're even worried about a potential war. By now, if you're subscribed to my channel, you should know that when asset prices drop, it's an opportunity for you to buy investments at a discounted price, aka buy the dip. But the interesting thing is that some people who buy the dip will end up losing all their money, and other people who buy the dip will end up making a lot of money. This is where it's very important for you to know what it is that you're investing in, and what I want to do today is go over 5 different categories of ETFs that you can invest in, that way you can invest your money through all of this market craziness and this economic craziness. The way that I'm going to do this video is I'm going to be going over the least risk category of ETFs to the most risky category of ETFs in my opinion. Now again, you want to make sure you always do your own due diligence. Never blindly listen to a random guy on YouTube. None of these ETFs are things that I'm recommending that you should buy. It's just something that you want to be paying attention to and things that you can consider buying, and then you do your own research. So let me start by talking about number 1, which is the S&P 500 ETF. And a couple examples of this would be VOO or SPY. Now, quick disclaimer, I own shares of VOO. So the S&P 500 ETF is an index. This is a group of 500 companies, the 500 biggest companies on the stock market. So when you invest in VOO or SPY, you're investing in all 500 of those companies. Now, if you were to go onto the Vanguard website and you look at the riskiness of this ETF, what you'll see is that it's on the more risky side of the scale rather than the least risky side of the scale. So why am I saying that this is the least risky way to go? Well, when I'm talking about ETFs today, I'm talking about ETFs that invest in equities, meaning ETFs that invest in stocks. I'm not talking about the ETFs that invest in bonds. Bonds have their own risks right now, especially when you're worried about high inflation and potential defaults. So I'm not going to be talking about bonds. I'm talking about ETFs that invest in stocks, that invest in companies. So this is the ETFs that invest in the biggest 500 companies on the stock market. And this is a lower risk ETF because, well, you're getting exposure to the biggest companies in America. If we go into a bad recession, the first companies that are going to go bankrupt are the ones that are extremely over leveraged. It's the ones that are not profitable, and it's the ones that really didn't have good business fundamentals. Well, these biggest 500 companies on the stock market made it here because they have better fundamentals, they have bigger profits, they've been around a long time. So yes, they can still go bankrupt, but the likelihood of one of these companies going bankrupt is significantly smaller than one of the smaller startup companies going bankrupt. So you have less risk with investing in this and less potential return, but this is one of those things where you're just getting the return of the market. I invest my own money into the S&P 500 ETF because I want to have broader exposure to the United States economy, and this is an easy way for you to get exposure to the biggest companies that make up the United States economy. The second kind of ETF that you can consider investing your money in is a total stock market ETF. Now, in my opinion, this is a little bit more risky investment than just investing in the S&P 500. An example of this would be something like VTI, another Vanguard ETF. And the reason why I say that this is slightly riskier than the biggest 500 companies in the stock market is because this is investing in pretty much every company in the stock market. This is something like 4,000 plus companies that this ETF invests in. And so if we were to go into a deeper recession, well, what's going to happen? Well, you're going to see companies go do layoffs. You're going to see companies go bust. And so this is investing in most of the companies in the stock market, all 4,000 some companies in the broader stock market here. Well, a percentage of them are going to go bankrupt, and you're going to have exposure to more companies here versus I would say that you'd have a smaller percentage of the S&P 500 companies going bankrupt. But if you're just looking for a way for you to get broad exposure to the entire stock market, this is an easy way for you to do that. Now, there are other ETFs that track this. I'm just a fan of Vanguard because Vanguard has been around a long time. They're one of the companies that create these types of ETFs. So Vanguard created VTI. So you can find the right one for you. I just like Vanguard because of, well, their reputation. The thing that you also want to be aware of when you're investing your money into these ETFs, not only is what ETF that you're investing in, but when you buy. Because a mistake that a lot of people make when it comes to investing their money into stocks or ETFs, especially when you're in a downwards market, is trying to time the market. And so a lot of people try to play this game where they want to get the bottom. They want to catch the market, the ETF, the stock right at the bottom. That way they can get the best share price. and there's no way for you to perfectly predict or time the market. So what happens to a lot of people is to try to time the market, and they either buy too early or they buy too late, and then the market goes up and then they miss the opportunity to buy. So an alternative to trying to do that is to do a dollar cost average system, where every week, every 2 weeks, every month, you pick your own schedule. I do every week. You just buy the ETFs that you like, and now when the market goes down, you just keep accumulating more and more shares. That way, now you're not trying to perfectly time the market. You're just dollar cost averaging your way down. So as the market goes lower, you keep buying. And then on top of that, what you can also do is add in an active strategy, where if you have a particular couple of ETFs that you like, well, if they drop really far, that can give you an opportunity to buy. And if it drops another 10 to 15%, you buy even more. The advantage of using an ETF as opposed to a stock is if you're investing in one company, well, you have a lot more risk because there's a chance that the company could go to zero. But if you're investing in an ETF, well, this ETF has hundreds, if not thousands, of companies in the ETF. So if one company goes bankrupt or it gets kicked out of whatever the ETF is, well, then they can add in another company. So you have less risk with an ETF, but also less potential return. With an individual company, you have more potential return, but much higher risk. For my dollar cost averaging, where every week I do every Wednesday, my money leaves my account and gets invested into a number of different ETFs. I use a platform called M1 Finance. They're also a sponsor for Minority Mindset. It's completely free to use them. I like it because it's very easy to use and they make it super simple, and it's completely passive on my end. If you want to learn more, you can check out M1 Finance and try it out for yourself, and I'll put their link down in the description below. The third category of ETFs that you can consider investing your money in is a little bit more niche now, so we're getting a little bit more risky, would be something like the consumer staples ETFs. Consumer staples are things that people need. These would be things like soap, hygiene products, food, drinks, alcohol, even tobacco is considered a consumer staple. And so if we were to go into a recession and people have to stop spending money on things like luxury items and designer name products, well, they're still going to need your consumer staples. People still need food, they still need drinks, they still need other things that you use in your daily life, soap. And these are the companies that these ETFs invest in, and a couple examples of this will be something like XLP and VDC. VDC is the Vanguard one, and XLP is another consumer staples ETF. XLP is a very popular one. This is arguably the most liquid consumer staples ETF. There's a lot of activity with this one, meaning there's a lot of volume. A lot of people own this one. VDC is the Vanguard version of this. Both of these ETFs invest in consumer staples companies. There's a lot of overlap there, but you're going to see some difference in ownership of certain companies, and you're going to see some different companies between these two ETFs. So what you can do is just go onto any financial news website, go onto Yahoo Finance, go anywhere else, enter in these two ETFs, and then you can see the different companies that they invest in and what ratio, and you can pick which one you like better. Do your research, but these are ETFs that give you exposure to those consumer staples. And if you want to know some of the historical data behind these type of consumer staples ETFs, back when the 2008 crash happened, these types of consumer staple companies were hurt. They were hurt hard, but they were hurt less hard than a lot of the other major ETFs. So again, if you're worried about a potential crash, you're worried about a recession, and you're wondering what type of ETFs that you can potentially invest in to help protect your money, in the past, especially during the 2008 crash, what we saw was that consumer staple companies were hurt, but not as bad as some of the other companies. The fourth category of ETFs that I want to talk about are getting a little bit more on the risky side, and this one has to do with more of a protectionary ETF. If you're worried about the United States economy, you're worried about the United States dollar, then you can consider investing your money into something like an emerging market ETF, because these are ETFs that invest in companies that are not in the United States. So now not only are you diversifying companies, but you're also diversifying economies and currencies, because now you're investing in countries like China and India and Korea and Brazil and Japan. And so now you're diversifying your money around the world into companies that are growing in economies that are growing in currencies that are not as stable as the United States dollar. But if these countries are growing and that currency becomes more stable, you can see more upside, but it also is more speculative and more risky because, well, these countries aren't as established and they're not as stable as the United States, and the dollar is still the world's reserve currency. A couple examples of this would be SCHE NVWO. This is a Charles Schwab ETF. This is a Vanguard ETF. I have my money invested into these ETFs as a disclaimer. And again, both of these ETFs are investing in one, different countries, second, different companies. So again, you can do your own research to see which countries and companies you like. And this is, again, a way for you to now diversify your money outside of just the United States. Because if you're worried about a potential recession, although a United States recession would affect the entire world, obviously the United States would be hit the hardest by a United States recession. So it's a way for you to diversify your money outside of just one economy and one currency. Now, if you are really worried about the health of the economy and the dollar, another way that you can invest your money in this protectionary way, if you don't want to invest your money in other countries and other currencies, would be to invest your money into ETFs. They give you exposure to precious metals. This would be something like GLD or IAU. These are ETFs that give you exposure to things like physical gold. Now, personally, I don't like the idea of investing in ETFs that give me exposure to physical gold. Instead, I like owning physical gold itself. I invest my money into physical gold. I'd rather have the actual gold than an ETF that gives me exposure to physical gold. But this is the next best thing, I guess. But this is pretty close to the next best thing, because now you're investing your money into a paper asset which is giving you exposure to physical gold. Gold is your traditional inflationary hedge. It's been a currency for centuries, hundreds and hundreds of years, and it's been around a long time. I mean, it's something that's in the earth and there's a limited supply of it. So everybody understands the value of gold. There's no real debate as to what the value of gold is. It's used in certain things, like as a conductor, it's used as jewelry, and people understand how gold can be priced and valued. So gold can be used really around the world, and this is a way for you to get exposure to that if you're really worried about the health of the economy and the dollar. And the fifth category of ETFs you can consider investing in, which I believe would be the highest risk category, would be the innovation side, the companies that are investing in new technologies, new innovation, and a couple ETFs that will give you exposure to this would be the ARK ETFs, and then this last letter would be like ARK-K, ARK-G, ARK-F. This is the ARK Innovation Fund, the ARK Genome Fund, the ARK FinTech Fund, and they have a number of others. ARK is led by Cathie Wood. I have my own money invested into the ARK funds, and these funds have been smacked hard over the last couple of months and the last year. And the reason why it's been hit so hard is because money has been flowing away from these momentum stocks. It's been flowing away from tech stocks into more of value stocks. And part of that has to do through an economic cycle, because as interest rates are going up, it's becoming more expensive to borrow money. And as it becomes more expensive to borrow money, people don't want to have their money into these growth, speculative innovation companies because they haven't produced any profits. And we don't know how sustainable some of these companies are. So when interest rates are going up and people are worried about a potential recession, they want to move their money away from these riskier companies, and they want to move their money into more of a safe investment, something that'll be around a long time. So you have to understand the risks with that, because when you go through this type of slowdown in the economy, when you go through interest rates rising, when you go through potential recessions, these are the companies that get hit the absolute hardest. And these are ETFs that give you exposure to a lot of these tech momentum innovation companies. So you have to understand that there's going to be a lot of risk and a lot of volatility with these ETFs, because these are the ones that, well, when things get hit hard, they're going to be getting hit hard first. Tech companies are the ones that started layoffs first. They're the ones that are already talking about hiring freezes. So these are the companies that, well, are going to be getting exposure here, but they're the ones that are going to be hit the first and potentially the hardest through this recession that we might be going into right now. For the people that are buying into these ETFs now, the hope is that you're able to buy into these companies at a lower price point or at a lower valuation before they start to go up, but there's a pretty good chance that it's going to go lower before it starts to go up, and that there's going to be a cleansing of some of these companies going away, which would ultimately hurt the price of these ETFs even more. What that means is there's a big chance that we could see these ETFs get hit a lot more before we start to see a recovery in this entire sector. And we don't know what that's going to look like and what's going to happen to interest rates and what the economy would look like. So there's a big risk on that side of things. However, if we see a big turnaround in the economy and these are the ETFs that are investing in innovation and technology, well, it could give you the opportunity to come in and buy at a huge discounted price, but understand that this also comes with some of the highest risk. Now, regardless of which ETF you decide to invest in, again, the most important thing is that you do your research and then you invest your money consistently and automatically and make it passive. That way you don't actually forget to do it, because the thing that people get wrong about ETFs is to try to just perfectly time the market. And if you have a system where every week or every 2 weeks you're automatically investing, where money is automatically pulled from your checking account and it's automatically being invested, now you don't got to worry about the market, because your goal with ETFs should be to be a long-term investor. Your goal with ETFs should not be try to trade the ETFs to try to flip them for a quick profit in 6 months, because if we were to go into a recession right now, well, it's not going to be the same as 2020, because in 2020, when that recession hit and the stock market crashed, well, the Fed opened up the money printer, and 6 weeks after the market crashed, we started to see the market rally again. Well, for that to happen again today, the Fed would have to do the same thing, but they don't have the ability to open up the money printer today like they could before, because, well, we're already facing such a big inflation problem, and more money printing causes more inflation. So the Fed doesn't have the same stimulus ability as they did back in 2020, because prior to the 2020 crash, we weren't facing the same inflation crisis as we were today. So don't expect the same thing as 2020 to happen again, where you see a quick V-shaped recovery like this if we continue to see the market crash. Expect it to be something like this, where it's going to go down, and then it'll eventually start to go up, where it's going to be a much longer, prolonged process. You're going to see some rallies, you're going to see some time at the bottom, and then slowly it will start to work its way up. It's not going to be a quick V like it was before, but again, this takes that discipline psychologically, because now you have to be willing to hold on to your investments, have the faith, keep doing your research, know what it is that you're investing in, and understand that you are a long-term investor. This requires you to have that patience to be a smart investor. Hold your sanity when everybody is losing their minds, because when things get rough, that's when everybody starts running around with their head cut off, screaming that the world is going to end. This is where you want to be calm and try to remember that things are typically not as bad as the media makes it seem, and things are typically also not as good as the media makes it seem. So when the media is talking about the world ending, chances are it's not as bad as what they say it is, and when they talk about how nothing can ever go down, it's probably not as good as it actually seems. So just remember that things are typically in the middle ground, and remember what your goals are as an investor, especially a long-term investor. Now, if you do want to go beyond just investing your money in ETFs and you want to learn how to invest your money in individual companies, you want to know how to research companies and do that sort of fundamental analysis, you can check out Market Insiders. It's an investing education app that I created. You can try it out for free, where every week you get access to stock market, real estate, and cryptocurrency coaching from really good investors who are actually doing what they teach. If you want to try it out for free with a free 10-day trial, I'll put the link to how you can do that down in the description below. If you enjoyed this video and you want to see some of the biggest problems with investing your money into dividend paying companies, I made a video covering that, and you can watch that video by clicking that button right over there. Thank you for watching, and as always, keep hustling. So one way that you can make money and get your share of the profits is through appreciation. So if you invest your money in a good company, this company produces more products, produces more innovation, produces bigger profits, and it's an attractive investment, you can see your share price go up